Hey guys, I'm Felix and this is my channel Fiscal Voyage. First off, I want to thank everyone who has subscribed to my channel and leave great comments. I currently just passed 850 subscribers and on my way towards 1,000, so thank you very much. I really appreciate you and for watching and commenting. It brings great support and helps me, motivates me to continue making these videos, so I really appreciate it. Thanks again. So in this video, we're going to do a stock analysis on JP Morgan Chase. This was suggested by Evergoo03. He left a comment in a previous video wanting a stock analysis on JP Morgan. But before we start, if you're new to the channel, make sure to hit that subscribe button and also leave a comment below if you have a particular stock or company you would like for me to analyze next. So let's get started with a stock analysis on JP Morgan. Alright, here's a stock analysis on JP Morgan Chase and Company, ticker symbol JPM. The company is a multinational investment bank and financial service holding company. JP Morgan Chase is ranked by S&P Global as the largest bank in the United States and the sixth largest bank in the world by total assets. I actually use Chase as my primary bank checking account, so I love their service, and I actually own shares of JPM. So with that, let's go ahead and start the fundamentals. From revenue grew at 1.3% annual compound rate from 2010 to 2019. Net income at a better rate at 8.9%. And actually, revenue for the past 5 years has averaged much better than the 10-year, with a 5-year average of 5.4%. So it has been improving much better than over the 10 years. As well as net income. Net income has a 5-year average of 10.5% compared to the 8.9% for the 10-year. So in recent years, both revenue and net income has been growing much better. And S&P credit rating of AA-, which is investment grade, which is good. And for the earnings growth for the 10-year period has grew at 11.7%. And the past 5-year average is actually better than that at 15.6%. So the company has been doing much better in recent years, so that's good news there. And we'll continue with the fundamentals. 2019 adjusted earnings came in at $10.72. Net margin at 29.9%, which has been improving a lot over the past 5 years. Net margin has been increasing every year, where 2018 it had 28.2%. Return on equity has been consistent around 14.9%. Currently, the company has a nice dividend yield at 3.68%. So that's a very nice dividend yield, meets my criteria as the minimum. So that's good there. And they have a great 5-year dividend growth rate of 16.2%, which is outstanding. And their most recent dividend increase was 12.5% last year, this time in June. So I'm expecting a dividend increase in the next few days or weeks for the next announcement. Not at the 12.5% increase, but maybe 2%, 1%. I think they might even freeze it. Who knows? But the cut is very unlikely. I think their dividend is pretty safe. As you can see here, the dividend payout ratio at 67.9%. It is high, but this is based on 2020 expected earnings. So and 2021 earnings are expected to be higher, and we'll see that in a few slides. But this dividend payout ratio is based on 2020 earnings, which is, of course, with the economic shutdown, has hurt a lot of companies' earnings. But even at 67.9%, the dividend looks safe and covered. And they've been growing dividends for 9 consecutive years. This is, of course, right after the great financial crisis in 08-09, where they had to cut the dividend. But ever since then, they've been growing dividend quite nicely. They have a charter rule of 19.9, which is the 5-year dividend growth rate, plus the current yield. Came in at 19.9, so that's great. Meets our criteria of 10, 11 and higher. So that's good news there. So we look at the balance sheet. The balance sheet is not too bad. Debt to cap at 37%, which is good. Current ratio is right on, basically 1-for-1, total assets versus liability, but total assets slightly more. Debt to equity at 1.29, which is okay. 1.5 is good, is okay, and less the better. but 1.29 is manageable, and the price to book ratio at 1.29 as well versus the 5-year average of 1.38. So it's undervalued based on the price to book ratio, and this price to book ratio is better than, of course, the 5-year average here. Future outlook, as I mentioned before, 2020 expected earnings is at $5.15, and we see here 2021 $8.64. 2020 earnings, it's about a little bit over 52% decrease versus 2019 earning of $10.72. But as you can see, for 2021, analysts expect the company to grow earnings at a better rate at $8.64. It's still lower than the 2019, but they have an annual growth rate of 5% from CFRA going forward. Using my dividend yield return model analysis, total return projected at 10.1%, which is a respectable annual rate of return. It meets my criteria of 9% or higher. And the current yield, or excuse me, the current PE is 12.2 versus a PE 5-year average of 12.8. So the forward PE of 11 is much better than both the current PE and the forward PE of 12.8. And the forward PE, I use the 2021 expected earnings. So that's how I get 11.1. So let's look at the fast graph here. The monthly closing price is the black line again, and the blue line is the normal multiple with a 12.3, and the orange line is a earnings multiple of 15. As you can see here, the JP Morgan tends to follow the blue line of a earnings multiple of 12. So right now, like I mentioned, the forward PE is under 12 at 11, and that's a good indicator that it's undervalued. And if you look at, I'm not even considering 2020 earnings because of, of course, the economic shutdown because of the pandemic. But 2021, you see, it has a 68% growth versus 2020, so that's very attractive. And the company before the economic shutdown was doing quite well. As you can see, in 2017, it had 11% growth in earnings, 18, 31% growth, and in 2019, 19% in growth. So I think the company is going to continue that trajectory with earnings growth once this pandemic and economic hardship clears up in the next by the end of the year and maybe the beginning of next year, hopefully. So I see the company growing at a very nice rate. But let's see, is it worth a buy currently? The fair value price for CFRA is $129.62. Morningstar at 113. Fast Graph at $106.66. Yahoo at 109. And my dividend yield return model analysis at $97.13. For that analysis, I use a 6% dividend growth for the next 3 years and 5% after that. I was quite conservative with these numbers here because even though JP Morgan was growing dividend at a nice double-digit rate over the past 5 years, and their most recent increase was also in the mid-double digits, but because of the situation, I think being conservative here is the way to go. So I use a 6% dividend growth rate for the next 3 years. So that's how we got to $97.13. But if you average out the 5, we get a fair price of $111.17, and currently the company goes for $95.52. That means the company is undervalued by 16.4%, which means my safety margin of 10% and greater. So that's good there, and that's why I have a recommendation as a buy for JP Morgan at current prices. As you just saw, I have a buy recommendation for JP Morgan Chase. First and foremost, that dividend growth rate is outstanding. As you saw, they have a 16.9% 5-year growth rate, as well as the most recent increase was 12% in June of last year. So I expect the dividend to be increased in the next day or two, or maybe next week. I don't see the dividend being cut, but even if they freeze it, it's okay because the company has been growing at a very nice rate in recent years. So I see that continuing. There's really not much not to like about this company. The company is very solid. The balance sheet looks good, and the projection annual rate of return looks good as well. and we get a 16.4% undervaluation versus a fair value price. So that gives us a safety of margin. If you have a stock you would like for me to analyze, please leave a comment below with the company name and the ticker symbol. And I'll put that in my list of companies that I have to research for you guys. And if you're new to the channel and you got this far, make sure to hit that subscribe button, and I'll see you guys in the next video.